Welcome to Alpha Insights. I'm Mark. Today we're unpacking SPY, the big S&P 500 ETF, and what recent volatility and macro headlines mean for portfolio positioning. Joining me is Jessica. Hey Jessica, thanks for being here. And remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Mark. Great to be here.
Okay, quick baseline. SPY is basically a hands-on way to own the S&P 500, right?
Exactly. SPY is the State Street S&P 500 ETF that tracks the index. It gives exposure to large U.S. companies across sectors, and it's one of the most liquid and widely used ETF vehicles for that exposure. Liquidity is the key point here. Deep secondary markets, a big options market for hedging, and that scale keeps trading costs low for big flows.
So, the real question here is, why has volatility bumped up lately?
Two main drivers. One, renewed geopolitical tension around the Middle East has lifted headline risk and pushed implied volatility higher. Two, central bank signaling, Fed Chair Powell's comments, and the incoming jobs and inflation data are shaping rate expectations. That combination makes intraday swings larger.
Right, and the VIX has moved accordingly?
Yes, the VIX has risen materially, showing elevated hedging demand. Options activity around key strikes is elevated, which tells you institutions are actively repositioning ahead of macro events.
Interesting.
When you look at the data, aggregate corporate profits are still holding up. Earnings revisions have nudged a bit higher overall, led by tech and energy, so fundamentals are not collapsing. But they're uneven across sectors.
And valuation. Where does SPY sit right now?
SPY's forward price-to-earnings ratio is roughly 17.8, which sits in the middle of recent ranges. Using a blend of historical multiples and conservative growth assumptions produces a fair value range roughly between $610 and $690, with a central estimate near $650. Those are index-level views, not trade calls.
So about $650 as a central number. Got it. What are the technical levels traders are watching?
Key resistance shows up around 650 and then about 680. Support sits near 620 and roughly $600. The index is a little choppier near-term, but still above many medium-term moving averages, so momentum is softened but not broken. Now to the scenarios. On the bullish side, continued earnings upgrades, especially from tech and consumer discretionary, and resilient consumer demand could push multiples a bit higher and drive upside. On the bearish side, escalation in geopolitical conflict, an adverse surprise from the Fed, or downward earnings revisions could re-rate multiples lower. And don't forget rates. Rising real yields can pressure equity multiples even if earnings aren't falling. That's a classic risk that can show up quickly.
Short reactions. Yeah, that's a good point.
Right.
Interesting.
For investors, the takeaway is to balance two things. One, the fund offers low-friction, broad, large-cap exposure and deep liquidity. Two, near-term noise from geopolitics and central bank signals increases volatility, so risk management matters more now than at calmer times.
Can you give practical pointers for different investor types?
Sure. Long-term investors should review their allocation to large-cap equities relative to their target mix and time horizon. Make sure volatility fits your plan. Short-term traders should watch implied volatility and the key technical levels we mentioned, and use defined risk tools if they need protection. And for anyone using options or leverage, execution timing and position sizing become more important during these spikes.
Quick reminder, folks, this is analysis for information only. We're not telling anyone to buy or sell.
Exactly. Analysts note the stance is neutral overall. Upside and downside risks are balanced, and your approach should reflect that uncertainty.
Before we wrap, give our listeners 2 or 3 key takeaways.
Okay. 1. SPY provides deep, low-friction exposure to U.S. large caps, but near-term volatility is elevated because of geopolitics and rate uncertainty. 2. Valuations are in the middle of recent ranges, not cheap, not extreme, so earnings revisions will be an important driver. 3. Manage position sizes and use hedges or defined risk strategies if you need protection during headline-driven moves.
Great summary. Thanks, Jessica. This was super helpful.
My pleasure.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for listening to Alpha Insights.